Have a good day. Welcome to Financial Management eLearning. Today we'll discuss Advanced Financial Reporting Module-03. So to start, Advanced Financial Reporting, we are in conceptual and regulatory framework for financial reporting. The need for a conceptual framework is the continuation of previous module. Recognition of the elements of financial statements. Recognition of the elements of financial statements, that recognition is the process of incorporating in the financial statements. It is the process, an item that meets the definition of an element and satisfied the criteria for recognition. And what is the criteria of recognition? An item that meets the definition of an element should be recognized if it is probable that any future economic benefit associated with the item will flow to or from the entity. The item has a cost or value that can be measured with reliability. So, recognition is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element. So items that satisfy the recognition criteria should be recognized in the balance sheet or income statement. That means I think it's a proverbial that any future economic benefit and item has a cost or value that can be measured reliably. So it is the recognition of elements of financial statement. It is the process. The interrelationship between the elements means that an item that meets the definition and recognition criteria for a particular element, for example, assets automatically requires the recognition of another element, for example, income or liability. Now, probability of future economic benefit. The concept of probability is used in the recognition criteria to refer to the degree of uncertainty that the future economic benefits associated with the item will flow to or from the entity. So the concept of probability use, recognition criteria refers to degree of uncertainty. That means a degree of uncertainty. Assessment of the degree of uncertainty attaching to the flow of future economic benefits are made on the basis of the evidence available when the financial statements are prepared. For example, when it is probable that a receivable owned by an enterprise will be paid, it is then justifiable in the absence of any evidence to the contrary to recognize the receivable as an asset. For a large population of receivables, however, some degree of non-payment is normally considered probable, hence an expense representing expected deduction of economic benefit is recognized. So we can say the concept of probability is used in the recognition criteria to refers to the degree of uncertainty that the future benefit that is economic benefits associated with the item will flow to or from the enterprise. So that is the probability of future economic benefits. Now the reliability of measurement. The second criteria of the recognition of an asset is that it possesses a cost or value that can be measured with reliability. In many cases, cost or value must be estimated. The use of reasonable estimates is an essential part of the preparation of the financial statements. It does not undermine their reliability. Reliability of measurements. Reliability, that means, do you get consistent scores every time? Retest reliability that people get consistent scores every time they take the test. And internal reliability is people give consistent scores on every item of the questionnaires. Integrated reliability to course rating of a set of targets are consistent with each other. If it is not possible for the item to measure rapidly, they should be disclosed in the notes, explanatory matters, and supplementary schedule. So, the reliability of measurement is the second criteria of recognition of an asset is there to possess a cost or value that can be measured with reliably. Recognition of asset. An asset is recognized when it is proverbial that any future economic benefit associated with the item will flow to the entity, and the item has a cost or value that can be measured with reliably. So, it is the recognition asset recognized criteria. It is proverbial that any future economic benefit associated with the item for the entity, and also is the cost or value can be measured with reliably. So, an asset is recognized in the balance sheet when it is proverbial that the future economic benefits will flow to the enterprise, and the asset has a cost or value that can be measured reliably. I think it's clear to you, and also you know it. And recognition of liability. Liability is recognized in the balance sheet when it is proverbial that an outflow of resource, economic benefits will be result from the settlement of present obligation, and the amount at which the settlement will take place can be measured reliably. So liability is recognized when it is proverbial that any future economic benefit associated with the item will flow from the entity, and the item has a value that can be measured with reliability. For some item that satisfied the definition of the liability, significant judgment is required to evaluate whether such items satisfied the recognition criteria. Individual IFRS provide the principle and application of guidelines. If you go to the website of the IFRS, then there is also clearly defined there huge resources waiting for you there. So liability is recognized when proverbial that any future economic benefit associated with the item for the entity and the value can be measured reliably. Recognition of income. When an increase in future economic benefits related to an increase in the asset or decrease of liability has arisen that can be measured reliably, this means the recognition of income occurs simultaneously with the recognition of increase in asset and decrease in liability. So, income is recognized in the income statement when an increase in future economic benefits related to an asset increase and decrease the liability. This can be measured reliably. Recognition of expenses. Expenses is recognized in the income statement when a decrease of an asset or an increase in liability has arisen that can be measured reliably. An expense recognition, look here. In the balance sheet, where the inventory is asset, when it's sold, it goes to the income statement as the expense side, cost of goods sold. In the balance sheet, when supplier prepaid asset is the asset, as used, when it's used, it goes to income statement, supplies expenses, insurance expense, rental expenses. In the balance sheet, when PPE, intangible asset over period that provides benefit, income statements, depreciation expenses, amortized expenses, etc., and other expense. So is the expense recognition. So we can say expenses recognized in the income statement when a decrease in an asset or an increase in liability has arisen that can be measured reliably. Now, measurement of the elements of financial statements. Measurement is the process of determining the monetary amount. So it is the vital thing. Measurement is the process of determining the monetary amount at which the elements of the financial statements are to be recognized and tried in the balance sheet and income statement. This involves the selection of the particular basis measurement. That means basis measurement. A number of different measurement bases are implied in different degrees and varying combination financial statement. They are historical cost. So what is historical cost? Assets are recorded at the amount of cash or cash equivalent paid for the fair value of the consideration given to acquire them at the time of the acquisition. So at the time of acquisition, what the cost, it would be the historical cost. Liability is the same. And current cost, asset carried in the amount of cash equivalent would have to be paid in the same as equivalent asset was acquired currently. That means at present price. Liability is the same as the current price. Realizable settlement value. Asset carried in the cash equivalent that would currently obtain in the settling the asset to orderly disposal. Liability is same way as the settlement value. And present value, the present discounted value of the future net cash inflow that the item expected to generate in the normal course of business. Same way liability. So, measurement of elements of financial statement, difference type, historical cost, current cost, realizable as settlement value, present value, etc. Now, absence of universally agreed conceptual framework. So if we not use it should be noted that no single framework is universally accepted. So there are a lot of frameworks. We have to consider it. This is due to the numerous factors, the variety of users of the financial statements, time and resource need develop universally agreed conceptual framework. Accounting convention is defined in different countries, and the development of an accounting standards may be influenced by the factors that the conceptual framework. For example, existing practice and political pressure. Okay. Now, accounting principle. We know we have accounting principle. Based on the principle, accounting principles are this: the conceptual, that means accounting assumption, accounting concepts, and accounting constraint, that means limitation. So accounting assumption is money unit, that means we'll discuss in later on. Money unit, economic entity, going concern, time period. And accounting concept as revenue recognition, matching principle, historical cost. And accounting constraint, materiality, conservatism, consistency, cost benefit, objectivity. So if accounting assumption is C, the money unit, that means accounting is only concerned with money transactions. Okay, so money unit means accounting is only concerned with money transactions. And business entity or economic entity, the business is separated from the owner. Good thing. Then going concern, assume the business will continue for long term. And time period is the business period is financial activities over fixed time period, usually annually, but surely annually. Okay. So now accounting assumption is money unit, business entity or economic entity, going concern, and time period. So accounting concepts are revenue recognition and realization. Revenue is recognized when it is earned. When goods pass to the consumer and they incurred liability of them. Matching or accruals. Expenses are matching to revenue, not payment matches to received. Full disclosure, disclose all information significant to the user. Okay. Historical cost, transaction are shown at cost historically. So accounting concept is revenue recognition, matching concept, full disclosure, and historic cost. Accounting constraint, that means materiality. Override over other accounting principle is the transaction is insignificant. Prudence or convertism. Prudence. Recognize loss, don't anticipate profit. Consistency, apply the same method of recognizing transaction each year. Cost benefit, the cost of applying an accounting principle should not be more than the benefit derived from them. Verifiable and objective evidence, transactions should have adequate documentary evidence. Accounting standards. Accounting standards are issued by regulatory authorities within a particular country to support accounting principles conversion, convention, and concept. In our country, we have the Financial Reporting Council. So Financial Reporting Council is the authority to issue the accounting standards and audited standards in Bangladesh. So, okay, objectives of financial reporting. Objective of financial reporting is to track, analyze, report the business income. Okay, the purpose of this report to examine resource use, cash flow, business performance, and the financial health or position. So if we see objective financial statement, it says number 1, past performance and current position assumption. Number 2, periodic of net income and judging the growth. Number 3, prediction of bankruptcy or business entities, another failure or going concern issue. Number 4, help stakeholders and other users to make economic decision. So, objectives of financial reporting: investment, decision making, management accounting, or decision making by the organization or management is helpful for management decision making. So if here we see that the objective of financial reporting to provide information needed for decision, element of financial statements, the information provided by accounting, that means asset, liability, equity, investment by bonds, distribution of owners, revenue, expense, gains, loss, comprehensive income, and qualitative characteristic attributed to the mark, make information useful. That means it should be understandability, reliability, and relevant, comparability, consistency, and assumption principle of constraint concept that provide a foundation, that assumption, economic entity, going concern, periodicity, monetary unit, principles, that means historical cost, realization, matching, full disclosures, and constraints, that means limitation, cost effectiveness have to measure, and materiality should be. I think this for today. So what we discussed today, we discussed statements, the probability of the future economic benefits, the reliability of the measurement, recognition of asset, recognition of liabilities, recognition of income, recognition of expense, measurement of the element of financial statements, absence of universally agreed conceptual framework, accounting principles, that means accounting assumption, accounting concepts, accounting constraint, that means accounting assumptions, monetary unit, business entity or economic unit, going concern, time period, accounting concept, revenue recognition and matching concept, full disclosure, historical cost, and accounting constraints, that limitation means materiality, prudence, consistency, cost benefit, variability, and objective-oriented standards, and objectives of financial reporting. So that's for today. We will meet with next module, inshallah. Till then, take care. Allah Hafiz.